I am here with Mark Yusko, of course, with Morgan Creek Capital. Great to have you on. All right, so let's move into the next topic, and that is, of course, cryptocurrency. It's pretty much ablaze right now. We've seen it in all factors. We've had a ton of people on our own show. Everybody from the team over at Algorand. We've had Mike Saylor on. All really kind of going into this direction. I want to learn a little bit about what Morgan Creek is doing around the essence of crypto in itself. Where are you guys moving with XO? Kind of talk to me about that.
Yep. So the short version, although as you can figure out, I don't do short well, is 8 years ago, kind of got introduced to it. My good friend Dan Moorhead said, come to San Francisco, buy a dinner, did that. And I made the first of my many bad decisions in crypto. He was starting a Bitcoin fund and a picks and shovels fund, a blockchain infrastructure fund. Look, I was not running drugs on Silk Road. I was not a cryptography student, didn't get Bitcoin in 2013, but I got picks and shovels. Made a lot of money in my career on picks and shovels. We put $500,000 into Google, took out $200 million. There should be a quad at Notre Dame called the Google Quad. We did eBay, we did Yahoo, all these crazy names that turned out to be household names. When you become a verb, that's a really good thing, like at Google. So infrastructure made sense. That fund's up 12x. No one's complaining, but I should have put the money in the Bitcoin fund. It's up 600x. Best performing fund of all time. But I didn't because I didn't get it and I didn't do the work and I was skeptical. And skepticism is great, but once you do the work, your skepticism goes away and you realize that this is a technological innovation, that blockchain technology is the operating system for the Internet of Value, that the trust net that's coming is going to be bigger than the internet, bigger than the mobile net, because it builds on top of those technologies, and that everything of value will be exchanged across internet protocol. In the same way that voice over IP changed everything for telephony and commerce, value over internet protocol or money over internet protocol is the great innovation of this century. So we started 3 years ago, almost 4 years ago, with a venture capital fund. We went out to raise a small amount of money. We're fortunate to get backing from two visionary CIOs at Fairfax County. Great article in P&I about them a couple weeks ago. And they put up $21 million of a $41 million fund. We invested in 23 companies around the infrastructure of the blockchain ecosystem, 20% of the fund into crypto, primarily Bitcoin, a little bit of Ethereum. That fund's done extraordinarily well, up multiples, probably 5 or 6x where we went in already, 3 years in. Raised a second fund about a year ago, and raised $100 million. Have put that to work, again, 20% in liquid protocols, 80% in equity of businesses. That fund's doing nicely too. It's up about 3x. So we're getting ready to raise our third fund, $250 million, maybe even bigger fund, to focus again on infrastructure and liquid protocols. Then in 2018, we were approached by some investors, said, hey, that private investment stuff, that venture capital stuff is interesting, but we want to own the liquid protocols. So we partnered with one of our portfolio companies, Bitwise, to create the Digital Asset Index Fund, which is a cap-weighted index of the top 10 cryptocurrencies, excludes Ripple and Lumens as being too concentrated. And then last year, we had people say, hey, we really just want to own some Bitcoin, but we're afraid of the volatility. So we created a risk-managed Bitcoin fund, which uses CTA technology to truncate the downside risk and mitigate some of the volatility. The interesting thing about Bitcoin has the same volatility as Amazon, right? And it took Amazon 21 years to get to $1 trillion. It took Bitcoin 12. So it's ahead of schedule. It follows Metcalfe's law nearly perfectly, as you mentioned earlier, in terms of growth relative to the number of nodes in the network. And what is Amazon, right? What is Facebook? What is Apple? They're not companies the way we think about companies. They don't make things. I mean, Apple makes things, but Facebook doesn't make things. Amazon doesn't make things. They connect people, right? Amazon is a search engine that connects buyers and sellers and takes a cut. And that is a very profitable business if you have lots and lots of people involved. When they had 5 or 10 or 20 or even 1,000, it wasn't very profitable. Today, with billions of people around the world, it's very, very profitable. So networks grow Networks grow at an exponential rate, not a linear rate. And that's the key to investing in this space.
You're right. I mean, with strategies around cryptocurrency in general, we get so many people in our comment section, and I get emails, DMs, all of this around strategies toward cryptocurrency versus stocks. Because even my own portfolio, I'm seeing cryptocurrency and the infrastructure companies that you invest in are outperforming, and we're doing it. Even my own personal portfolio, we're doing it in a somewhat inexperienced state, but we're finding the performance levels are just, they're just not even a comparison to what we're seeing on Wall Street. So when you have those kinds of situations happening in what you're doing with your fund, do you feel like, and it sounds to me like you guys are doing a ton of infrastructure investment as well as the small amount of cryptocurrency.
Yep.
So you believe that right now it's kind of the old, everybody's building the railroad, so to speak,
right,
that eventually will be utilized to transport all of this digital currency across the world. You really are big all in on those kinds of companies. Is that right?
Oh, 100%. Look, I mean, again, I was fortunate to be there early for Web 1.0. And the best way to think about web and the development of the internet, the mobile net, and now the trust net is the internet, Web 1.0, think of it as if you think of a parabolic curve in the northwest quadrant of an XY graph, on the left-hand side where it's parallel to the x-axis is Web 1.0. And the area under the curve doesn't even look like that much, but that's Microsoft and Intel and Cisco. Pretty big deal, pretty big companies.
Yep.
Then Web 2.0 is when the knee of the curve starts, and the area under the curve is bigger, but still not that huge. But that is Alibaba and Tencent and Amazon and Netflix and huge wealth creation, first $1 trillion companies. Now we get to the vertical part where it goes vertical to the y-axis. The area under that curve, really big. That's Web 3.0. And the same way that we have 5 protocols in the internet, we used to have 80. Now there are 5, TCP/IP, HTTP, SMTP, FTP, and www. I believe there'll be roughly 5 or 6 protocols in Web 3.0. I think Bitcoin's the base layer. I think Ethereum is www. I think Filecoin is like FTP. And then is it Polkadot? Is it Cosmos? Is it Solana? Right. I don't really know what the other 2 are going to be. I'm not that techie, but something will establish itself as that, second and third layer protocols. And we will have an opportunity to create really just unprecedented wealth. And the cool thing about it is TCP/IP, right? Vint Cerf invented it. And then Tim Berners-Lee came along and invented the internet, not Al Gore, by writing the first web page. Tim's not a rich guy. I mean, he's doing fine, MIT professor, but he's not a rich guy because he didn't get paid for inventing the internet. TCP/IP is free. Who got paid? Zuck, by creating Facebook, a free application. By the way, if it's free, you're the product. And it's an application built on the protocol. The cool thing about now is you can actually own the protocols. You can own Bitcoin as the base layer protocol. You can own Ethereum as the www. As the workhorse toolkit of this internet of value and the base layer for DeFi. So you can get paid either in gas fees in Ethereum or in DeFi fees like Uniswap, and you can own a piece of these businesses before they become applications that run on top of the protocol layer. So very exciting, very misunderstood. Average person has no idea what you and I are talking about today, but they should. And everybody needs to get off zero, right? Zero exposure to digital assets is wrong. You have to have exposure. And the biggest reason you have to have exposure is it's uncorrelated to your traditional assets. And therefore, it improves the risk reward of your portfolio. Harry Markowitz won the Nobel Prize. When you take cash, the riskiest asset there is, and you add bonds, which are riskier, the risk of the portfolio goes down. Add equities, risk goes down. Add venture capital and hedge funds, risk goes down, not up. By adding Bitcoin, which is 0.15 correlated to stocks, 0.0 correlated to bonds, you get a more efficient portfolio, and you don't need a lot. You need 1.35% to make an extraordinary difference. Over the past 5 years, right? The first 5 years of Bitcoin, more like a science experiment. Last 5 years, real money. Could have put a lot of money to work. Could have put $5 or $6 billion to work 5 years ago. If you put 1% of your portfolio, is 60-40 portfolio stocks and bonds, instead of making 7.2 over the past 5 years, you would have made 9.2. Now, the cool part is, had it gone to zero, which I would argue was impossible, but some would say it could still happen, you still would have made 7%. That's a 10-to-1 upside downside. Had you put 5%, you would have made double. You would have made 15% instead of 7.2. So the key is, by adding this uncorrelated asset, the first truly uncorrelated asset, and it's uncorrelated because it derives its value not from where stocks and bonds get their value, not from GDP growth, not from interest rates, not from innovation, but from the actual innovation itself, from millennial adoption because of the digital divide. One of the things I talk about all the time, ask anyone over 35, who's your broker? Oh, UBS, Merrill Lynch, whatever. How much gold do you have? I don't know, 5, 6%. How much Bitcoin do you have? Oh, are you kidding me? It's a Ponzi scheme. Don't you hear Warren Buffett? Nothing, zero. Okay. Ask anyone under 35, who's your broker? What's a broker?
Robinhood.
I got a Robinhood account. How much gold do you have? Oh, are you kidding me? Boomer rocks? Zero. How much Bitcoin do you have? I don't want to talk about it. Why not? Because it's a really big percentage of my net worth. So as we think about the 37 trillion, right? And a trillion, 1 trillion is $1 every second for 31,710 years. $37 trillion will transfer from my generation to my kids, the boomers to the millennials. That money's not going to traditional assets. It's going to crypto assets, going to digital assets.
Well, and you've seen this kind of this shift between really kind of the generations that have occurred. So boomers now aging out in the sense of retirement. Gen X, to a certain degree, there's kind of a hyper categorization of Gen X that are moving into crypto, and then some that are kind of going the old school route versus, traditional stocks and bonds, not the kind of portfolio diversity you're talking about, which is interesting. And then you have the millennials, and eventually will be Gen Z, which is really going to be the new evolution of where investing and use of this whole infrastructure is going to begin, because that at that point, when we see, our under 20-year-olds really started utilizing the digital currency platforms that will be available in 5 years, that's, I think, when we're going to see a massive adoption shift that just will be unstopped.
Think about this. Think about this ridiculous system that we've set up called the 401k. 401k mandates that you basically have to use the service provider that you're given, which are mutual funds.
Right.
And you basically are given choices between stocks and bonds. Very little diversification, no real assets, no venture capital, none of the best asset classes that the endowments, foundations, sovereign wealth funds have made lots of money on in the past. And you're given basically no guidance. So you're asking young 20-year-olds to allocate their portfolio. So what do? They're either afraid, so they put it all in bonds and GICs, which is the worst possible thing. In fact, it should be against the law for a 25-year-old to hold bonds in their 401k because they can't touch it for 50 years. It should be all in venture capital and long duration assets. Or they put it all in stocks at the wrong time because they don't know any better and they chase, the bull market like in 2000. That's why the average person only has $44,000 saved for retirement, which is a travesty. What we need, imagine a day where you have a digital portfolio, where that digital portfolio rebalances, day by day, hour by hour, whatever duration you want.
Right.
And it can own everything. It can own the best performing asset over the past 10 years, which is not Bitcoin. It's actually collectible Porsches. So you can own a fractional share of collectible Porsches. You can own art. You can own agricultural land in former Soviet Union, breadbasket of Europe. You can own innovation through venture capital companies. You can fund founders through crowdsourced funds. And the portfolio does it all in real time, and you get a perfect allocation because the algorithms are seeking to optimize your portfolio rather than you setting it up on the day you get your job and never changing it. That's the crazy stat. People set their allocation 1/n. If they have 5 choices, 20% each. If they have 10 choices, 10% each, and they never change it. That is a bad way to manage money. Imagine an algorithm using digital assets fractional ownership of every asset in the world, that is a better system. And that's coming. And it's going to be incredible. And it will create more wealth and more independence for this generation.
Do you see? Okay, so let's talk about that for a second. So AI obviously going to be just an evolution of what we're going to see in terms of machine learning, advancing up to true level AI. Obviously we're seeing these in the autonomy side of things with electric car. A lot of engineers. We were talking with some engineers just the other day about AI, and they gave me a stat that was a little bit scary in the sense that there's only about 2,000 engineers globally that are capable of running on a true AI tech stack of being able to go to work at Tesla, go to work at Google, DeepMind, you name it, or in your scenario, maybe go to work with someone that is going to be in a DeFi or a CeFi type world.
Yep.
How do you see that? Because I feel like that could be a ceiling that's going to be a hard one for us to overcome, just being able to get our engineers in position to be able to move in this. There's only going to be a handful of winners, it looks like. What are your thoughts on that?
We're going to outsource it all to China. Look, we graduate 450,000 STEM graduates every year, about 200,000 engineers, 250,000 math and other science. China graduates 4.5 million. They invest close to $1 trillion a year to encourage education in innovation. We're actually having a 3-day webinar on our China activities today and tomorrow, the next day. And we had a guest speaker today who was talking about this in that, imagine this, China doesn't actually tax their CEOs at a higher rate. They don't actually tax capital gains at a higher rate to discourage innovation and wealth creation. They don't chase their CEOs out of San Francisco and make a move to Austin and Miami, right? They actually are encouraging, they give subsidized rent, they give subsidized businesses, they reimburse for education. They are encouraging being number one. And look, this is a long-term plan. 10 years ago, China decided we want to be number one in 5G and AI. The US decided to be number one in social media. So we rocket Instagram and Facebook, but I'm going to say AI and 5G are more important, and they're winning that race. And so whereas we outsourced our manufacturing, our low-paid jobs in the past, now we're going to outsource our high-paid jobs. They're still going to cost less, about 20 to 40% less than a US graduate, but it's all going to be done. AI citations this year in the AI journal, first time, more Chinese than anyplace else.
Interesting. Okay. Well, that's of course going to be the kind of scenario that we'll be running into. We look at the EV space heavily. I was surprised at the amount of support that the Chinese government was giving to companies like NIO and BYD. Both are really they're literally being propped up by the Chinese government. Sure. So when you see that kind of flex into that space and then kind of what they're doing with digital currency, China, in the essence of where cryptocurrency is going, obviously China is one of the number one, mining region of the world in terms of Bitcoin. Where do you see with digital currency of where China is going to stand in a decade as opposed to the rest of the world, which is based
number one?
It
won't even be close.
Petrodollar.
Yeah, number one. Look, the digital renminbi will be first, and Russian ruble will probably be second, and we'll come in a distant third because we fought it. And why we fought it, I don't understand. And I always say, I hate to quote Ricky Bobby, but if you ain't first, you're last. And we have U.S. dollar hegemony around the world for a reason. We cut a deal with the Saudis in '74. We said we'll protect you in exchange for pricing oil transactions in dollars. And so today, 60% of global trade transactions are priced in dollars. 8% of global trade is with the United States. That is going to change when the digital renminbi is readily available and people can buy it. Think about being in Venezuela. Maduro comes in, he basically steals all the wealth, puts it with his cronies, and devalues the currency. What did you do? You ran out into the street and tried to find greenbacks, literally physical green pieces of paper, dollars. Well, if you couldn't get those, what did you do? You bought some Dash. Well, if you couldn't get enough Dash, what did you do? You bought some Bitcoin. If you could get an internet connection, and you actually preserved your wealth. Look at Argentina. During the great bear market of Bitcoin, 84% drop in price in 2018, Argentinian Bitcoin prices went up every day. Turkish Bitcoin prices go up every day because supply doesn't meet demand. And so as the more people use this store of value, cryptocurrency, as more people realize that this trend is not going away, that cryptocurrency is a better system than fiat currency. It's inevitably deflationary as opposed to inflationary. Once people wake up to the fact that inflation is taxation, that inflation is what causes wealth and income inequality, it's a plan that was hatched in 1913. Actually, that's not true. It was hatched in 1600s by the Rothschilds. We adopted it in 1913 as our own. And look, inflation, the myth that inflation is a good thing is exactly that. It's a myth. It is a wealth tax, and it steals from the masses and gives to the rich. And cryptocurrency, particularly Bitcoin, obviates that. It gives you, as I like to call it, schmuck insurance, and it allows you to take a portion of your wealth outside the system that is being devalued every day. One thing that people haven't paid attention to, in the past 12 months, 39% of all the dollars created in the history of our republic were created. And so the nominal price of everything is going up. Housing prices, crazy. We had the greatest increase in housing prices in a quarter in history, 18% quarter over quarter. We have art selling at ridiculous levels. We have collectible cars at ridiculous levels. We have everything that is scarce going up. Stock market making new highs. Only if you denominate in a depreciating currency, the dollar. If you denominate the stock market in Fed balance sheet, it's dead flat since 2008. If you denominate in gold, it's dead flat since 1996. If you denominate in Bitcoin, it's an ugly chart.
Yeah. Yeah, it's all right. So jumping from that, because I see this in the sense of where the U.S. dollar is really, well, it's already in, we're seeing a continuation of a 2% drop. We see this over a decade now. You're at 20%. So I definitely see the shift going in this direction. The question is how many, Americans in general are going to be exposed enough, quickly enough to what's happening to be able to, in some cases, save their own retirements, which are coming down the pipe in the next decade. That's going to be the real issue. So when you look at that, and we go over to the banking system as it is today, and let's just go to institutional money. Let's go into major corporations moving treasury into crypto, including Tesla. We've seen MicroStrategies, what they've done. And a handful of others. I saw an esports gaming company moving their crypto or their treasuries into crypto. Do you feel like this is going to be just something that becomes a strategy for all business operators, large and small, moving forward in the next few years?
Yeah, look, I think everyone, every individual, every company, every pool of capital, like an endowment, a foundation, must take a portion of their assets, not all of them, but a portion of their assets, and opt out of the fiat system. Look, the fiat system doesn't have a long track record of success. There have been 775 paper currencies in the history of the world. 3/4 of them no longer exist. The rest that still exist have been devalued 95, 98, 99%. And I ask people all the time, what's the lowest price you remember for a gallon of gas, right? Mine was 31 cents when I was a teenager in Kirkland, Washington. And I was visiting my daughter out in California a year ago before the lockdown, and I paid $4.31 for the same gallon of gas. Now, wait a minute. It's actually less good because it has ethanol in it now, but let's assume it's the same gallon of gas. It doesn't do any more, it doesn't generate any more heat, doesn't power my car any better. But why did I pay $4.31? Not because the gas is better, but because the dollar is worse. And it's that slow boiling of the frog that people don't pay attention to. And you ask the question of how are Americans going to save themselves? They just have to wake up, right? They just literally have to jump out of the water before they're so paralyzed that they can't move. And those that do, right? Those that opt out, again, not for everything, but for a portion of your assets, and you embrace the fact that the system is rigged against the average person. It's just the way it is, and it always has been. And that's the way power systems work. And if you do nothing right? And you end up on a fixed income with a retirement that's, fixed, then every day that there's inflation, you get a little less rich. And so you need to have assets that are inherently deflationary in your portfolio, things like Bitcoin, things like Ethereum, things that have this ability to store value, gold as well, and other things like silver, other precious metals, scarce assets. And if you don't do that, right, if you stay in fixed income, for example, thinking it's safe, or stay in cash, thinking it's safe, or you keep cash in your treasury. And this is the aha moment Michael Saylor had. He said, wait a minute,
Yep.
I have less purchasing power in my treasury today than I had a year ago. And you think inflation was bad over the last few years? Well, wait till you see
Exactly.
the prints this summer. The prints this summer are going to blow people's minds and are going to cause a lot of consternation, because we're going to hit, mid-single digits, maybe even high single digits of inflation. And that's the reported inflation. That doesn't even include the reality, because a big chunk of what's reported as inflation is owner's equivalent rent, the rent you charge yourself if you rented your house from yourself, which, by the way, you'd never raise and has been flat for a decade. So housing prices just went up 18% in a quarter. If they put that in CPI, whew, look out.
Yeah. All right. So, okay. You get into uncharted waters here, especially as we look moving forward. I mean, the next decade is going to be an interesting one, that's for sure. I want to get into the last two topics. One is because the evolution is occurring in terms of the platforms that access points are essentially being cultured, in the sense that you've got Coinbase obviously going public, companies like BlockFi, Gemini, Celsius, Nexo we've had on the show here. All Voyager Digital with Steve just jumped on the show. Where do you think these platforms will shake out? Do you feel like this is kind of the new DeFi, CeFi banking infrastructure that eventually will just become the infrastructure for digital currency in general? And do you think there will be a race to zero like there has been in the trading platforms in terms of service fees and things of that nature?
So yes, and all great points, right? So we have TradFi, and at the center of it is the banking industry and all the peripheral things around it, mortgage lending and traditional lending and all of that. And a lot of that's been under attack, as we talked about earlier, by fintech. But now, with the evolution of fintech into digital assets, so now we're going to have CeFi, centralized finance, which is basically banks with digital assets, right? BlockFi, one of our biggest investments. You can't call them a bank, but what do? They take deposits of digital assets, they pay interest and lend them out. That's a bank. Oh, we can't call it a bank, so we call it blockchain financial, BlockFi, because the banks get mad if you call it a bank. But it is a bank. And there will be digital banks and other groups that you mentioned, a number of them, that do the same thing. And people say, oh, no, we all need to go to DeFi and everything needs to be decentralized. Kind of. Think about this. How many people control their own money? People say, oh, not your coins, not your keys, not your coins. Okay, fine. Let's apply it to money. How many people stuff their money in their mattress or their wall safe? Not that many. They put it in a bank. And then it's no longer your money. It's the bank's money. And you have an IOU from the bank. But we're comfortable with that because we don't have to worry about safekeeping. We don't have to worry about fire and theft and someone with a gun coming to your door and say, give me your money. Bare assets are tough. So having a centralized authority to help you makes sense. So I think digital assets as bare assets do have some personal security risks and technological and logistical risks, that having a centralized authority to help you makes some sense. So I think those businesses will thrive. I think we'll probably have the big four, like we have the big four in banks, and we'll have the big four, and BlockFi will be one, and Gemini will be one, and who knows who the other two will be. But I think that will happen. And then ultimately we'll move to DeFi, and DeFi will take things that are easy to do, lending, deposits, like money market accounts, money market mutual funds, gone. Yeah. No reason to have them, right? The digital version is better, compounds better. Online lenders, probably gone. Digital is better. I can stake my collateral easier. I can make the loans easier. It's nameless, it's faceless. I don't have to do one-to-one, peer-to-peer. I can put it in a pool. So I think all of these technologies are going to thrive. And I think this transition from TradFi to CeFi, then CeFi to DeFi, with CeFi at the core and DeFi around the periphery in the different segments that make sense, is inevitable trend. And I think what's funny for some people is, because you're just busy doing, living your life and doing your job and taking care of your kids and planning for, retirement and college, most of us miss these big moves because they don't happen immediately. They happen over time. I mean, blockchain is not a new technology. It's been worked on for a lot of years. And probably for the first 20 years, from the 80s to the 2000s, it didn't catch on because it was run by a bunch of anarchists. I mean, you're an anarchist, you sit up in your house by yourself with your guns and you don't influence anybody because you don't have any friends that are coming by. So it took Satoshi Nakamoto, whoever he, she, they are, to kind of popularize this technology and give us a use case for blockchain for people to have the aha moment that this is a technological evolution. And now what we're going to witness is financial natural selection, and you will either adapt or die.
Yeah, definitely on the track. I think for anybody that's covering, and of course all of our audience, they understand this probably more so than anyone, which is the cool thing. If you're a TechPath listener, you guys, or watcher, you guys are definitely on the current edge of where investing, cryptocurrency, all that is going. I want to get your last thoughts on the coins themselves. So we've seen really a massive move with Ethereum here recently. You've mentioned it a lot during this interview. Your thoughts on Ethereum? I mean, could we see Ethereum really break out into a true A-class type crypto scenario like what we've seen with Bitcoin?
No, look, I mean, I think they're different. Not better or worse, but just different. I truly think Bitcoin is the store of value. I think it is digital gold. I think it won. And look, Paul Romer won the Nobel Prize for the law of increasing returns. It's not the best technology that wins. It's the technology that gets critical mass the fastest. Betamax and VHS, perfect example. And Bitcoin, or CPM and DOS, right? CPM was a way better operating system than DOS. Way better. I mean, not even close. But the true story is the IBM guys flew to Seattle. They met Bill, thought he was the coffee boy, said next, went down to California, tried to meet the husband and wife team. The husband was like, I won't meet with you unless you sign an NDA. IBM's like, we're IBM. We don't sign NDAs.
Whatever.
Said, I won't meet with you. Okay, back to Seattle, sign the contract, and the rest is history. Now we have to restart our computer like we had to do before we started this. So the reality is not the best technology. It's critical mass and Metcalfe's law that matters. So Bitcoin, I think, wins store of value. Now, it also, I think, wins as the base layer protocol, but Ethereum is different. Ethereum is this toolkit that I think lots of things are going to be built on, and it has elements that are superior in terms of speed and functionality that you don't have to be just like Bitcoin. You can be something different, and there's room in the stack for Web 3.0 for multiple protocols to be big winners. And I think Ethereum is one of them. And how big can it be? Big. Someone asked me the other day on a podcast, well, is it money too? No. Bitcoin is money. Money is an asset that exists in the absence of a liability. Gold has been money for 5,000 years. Bitcoin is digital gold. It has all the properties of gold. Scarcity. It's more scarce than gold today, as the last halving. And it's more portable, more divisible. And I think it wins. So Ethereum isn't that, right? It doesn't have to be money. Can it be big? Yeah. Can it be really big? Yeah. Can it be really ubiquitous? Yeah. Can it scale? Sure, as long as the developers keep developing it. Will other things be built on it? And will we trade lots of ERC20 tokens? Absolutely. But I don't think they're equivalent. I don't think they need to be equivalent. And so when people get all maximalist and all tribal, I think it doesn't make sense. Embrace it and embrace the other things that are coming up. Look for other projects. The problem is we have the noise, right? We have 2,000-ish tokens that are worthless, right? They were crowdsourced, venture capital, came public in the ICO boom. And most of them don't give you claim on equity, debt, or claim on cash flow. And they're basically worthless. They were basically a honeypot for people to go buy Super Bowl ads and throw parties. Not very interesting. There are some new things that now allow you to share in the revenue, share in the governance, share in the creation of new assets, things like synthetics or Aave or compound or
Yeah.
I mean, there's a whole bunch of new innovative structures that will also become very large and very profound in our world as we move to a crypto focused world. And crypto has this bad rap. It's like, Charlie Munger said, I don't like any word with the word crypt in it at my age. No, crypto is not crypt, right? It's not crypto like evil. It's cryptographically secure. And I met with a company the other day, a founding group based in Israel. They think they have a way to bring cryptographic security to the cloud through chip design. If that's true, it's going to be a really big company, like really, really big, like AMD, NVIDIA big. Now, are they going to be able to do it? I don't know. But if they do, it's going to be big. And so this idea of cryptographic security at every level of technological innovation in our lives is a big deal. And everything we do going forward is going to come back to this same nexus where the ownership of assets, the transfer of assets, and the exchange of value will be driven by this cryptographically secure technology. And one parting thought, Eric Schmidt, who knows a thing or two about tech, said it best. He said, what Satoshi Nakamoto did is basically create a digitally scarce asset using blockchain. That's pretty cool. That has value. Some big companies will probably be built on that. And that's the key. A lot of companies will be built on this idea of digitally scarce assets.
Yeah, for sure. Mark Yusko with, of course, Morgan Creek. Great to have you on the show today, man. Thanks for stopping in.
No, thanks for having me. I enjoyed the conversation a lot.
Yeah, very deep. All right, all of you listening in over on the podcast right now, make sure and subscribe. If you are tuned into our YouTube channel, make sure and like this video and also hit the bell so you get notifications of content like this from TechPath. And of course, if you have an idea for a show, you can shoot us an email the old-fashioned way to producers@revernetworks.com, or you can hit me up on Twitter @PaulBaron, or just leave it in the comments below. We'll get to it there as well. Anyway, we'll catch you soon right here on TechPath.